Before this video, I uploaded a video on financial liability amortized cost through assets. That is question. If you haven't watched that, kindly do so. Get certain concept before we move on with days on. Alright, so as usual, we shall read the question, break it down, and go into it on the sheet. So, on 1st January 2016, Swan issued 3-year 5% 300,000 notes at nominal value with the effective interest rate at 5%. The loan note will be redeemed at par. Market interest rates as at 31st December 2016 is 6%. Market rates 31st December 2017 is 4%. The transaction is classified as fair value through profit or loss. Explain and illustrate how the loan is accounted for in the financial statement for the 3 years to 31st December 2018. So the question has been read. It's left for us to go into it. So the commencement of the loan is 1st January 2016 and it was issued at par. No discounting here. That's 300,000. The effective interest rate is 5%. The coupon rate is also 5%. The loan will be redeemed at par, which means that it will be redeemed at its face value, its par value, its nominal value. It wouldn't be redeemed at any value more than or less than 300,000. And in this, there were changes in the effective interest rates. Yes, so the changes in effective interest rates may be as a result. One of the main reasons would be as a result of inflation. Sometimes, due to that, the effective interest rate has to change. I think that's the commonest example we can give, but there are other factors that may be linking to the changes in the market interest rate. So at the end of 2016, it changed. So we started the year with 5%, but at the end of 2016, it changed to 6%. And at the end of 2017 also, started at the beginning of 2017 with 6%, but it changed to 4% before we entered 2018. And another interesting point here is that the transaction is classified as fair value through profit or loss. Remember, the standard says that with financial liability, you can either amortize or at inception, the entity can classify through fair value through profit or loss. You are being told to explain and illustrate how the loan will be accounted for in the financial system. As I said earlier, if we are being told to explain, we can make short notes from what I have already said. We can make a short note out of it, and the remaining is figures. Now let's go to the sheet. So in this question, since we all know it has been issued at par, we know the double entry system by now, so we can pass it ourselves. So we'll just move straight to the most important aspect of it, the amortization schedule. Since it was issued at par, as we all know, we have been passing the journal for quite a long time now, but for now, we are focusing on the market changing, the interest rate changing, right? So I think the journal wouldn't be needed here. So in this question, it has a component of amortized cost and also fair value through profit or loss. The reason for the fair value through profit or loss is for the purpose of what? The changes in the market rate, where the income will be going. At amortized, it has the element of the amortized cost, effective interest rate here, coupon here. So it will be amortized blended with fair value through profit or loss. The fair value through profit or loss here is just telling us the direction of the income. Where should our gain, as a result of the changes in the market rate, where should our gain go? But the amortization schedule will still hold. So let's go into it. So at the beginning of the year, we start with our par value. That's our face value because there wasn't any transaction cost, there wasn't any discount. So we have here as 300,000. And then we charge effective interest rate. So if the question is silent, we should always know that payment is made in arrears. So since the effective rate is 5%, 5% of 300,000 is 15,000. And then our payment is always in bracket. The deduction for 15,000. For the purpose of the nature of this question, I would like to list our payment. The payment will be made. Since the payment is fixed, let's list them. So another 15,000. At the end of 2018, it's not 15,000. It will be, we were told that it will be redeemed at par. So it will be the 15,000 plus the par value. That is 315. So at the end of 2018, it's not going to be 15,000. It's going to be the par value plus the coupon. So the par value plus the coupon. That's the par value, which is 300,000. Remember, we were told it to be redeemed at par. So that's 300,000 plus the coupon of 15,000. So we are going to have minus 315,000. Right. Yes. So at the end of the first year, our closing balance is 300,000. At the end of the first year, our closing balance is 300,000. So the opening balance was 300,000. The effective interest rate 15,000. Coupon 15,000. We have a closing balance of 300,000. In the question, at the end of 2016, our interest rate has changed to 6%, which means that we will use 6% starting from 1st January 2017. So it is going to have an effect on our closing balance for 2016 because we need to have a closing balance that will suit the new interest rate. Okay, so in this question, as we can see, the closing balance here is equal to the present value of the remaining unpaid amount. The closing balance of the instrument is equal to the present value of the unpaid amount. So let's prove this. So the unpaid amount, so now we've paid for 2016. So 2017 is unpaid. 2018 is unpaid. And we are saying that the present value of the unpaid amount should be equal to the closing balance of the previous year. So let's prove this. So we have here our 15,000. We have here our 315,000. And if you want to find the discounting factor, so we use the discounting factor 5% for the 2016. We are assuming that there wasn't any change in interest. So we want to prove that the present value of the unpaid amount is equal to 300,000. So let's use the actual effective interest rate of what? Of 5%. And let's prove this and let's see if it is true. So the discounting factor for the first year, that's 2017, that's to be 0.9534. And the discounting factor for the second year, that's 2018, is going to be 0.907. So we can see, so the closing balance of 2016 using the actual effective interest rate without it changing, it should be equal to the present value of the unsettled coupon. Is that okay? Yes. So with that established, now at the end of 2016, the effective interest rate changed. So we need to remeasure our closing balance. Since the effective interest rate is no more 5%, we have to, which means that our closing balance has to be remeasured before we enter the new year, that is 2017. So instead of 5% interest rate, we will be using the changed interest rate, which is what? 6%. Which is 6%. So using that, our discounting factors are going to change. So our discounting factor for 2017 is going to be 0.9434. And for the second year, which is 2018, it's going to be 0.89. 4 decimal places. So at the end of 2016, we have remeasured our closing balance because the market rate has changed to 6%, and we cannot enter 2017 with a closing balance that has the effect of 5%. We need to remeasure it to suit the 6% we are approaching. So our closing balance now becomes 294,501. So this becomes our new closing balance. And so since it is a financial liability, a reduction in the closing balance is a gain. So the difference between this and this will give us a gain of what? 5,499. So we entering 2017, we are going to enter 2017 with this value instead of this 300,000. So we are going to enter 2017 with 294,501. And our effective interest rate 2017, we all know that now it is 6% because it changed at the end of 2016. So effective from 1st January 2017 is going to be 6% and not 5%. So we will charge 6% on this. Charging 6% on that, we are going to have 17,670. Yes. So having done that, so we know our coupon is still the same. So our closing balance using the effective interest rate of 6% for 2017 is 297,171. So 297,171. So, and we were also told that at the end of 2017 too, our effective interest rate fell to 4%. So if it has fallen, which means that we need to remeasure our closing balance before we enter 2018, because since the effective interest rate at the end of 2017 reduced to 4%, effective in 2018 is 4% and no more 6%, which means we need to remeasure our closing balance so that it will suit 2018 4% market rate changes. So, as we also know, the present value of the ensuing year's closing, the closing balance of the ensuing year is equal to the present value of the unpaid amount. So, we need to find the present value of the unpaid amount. So, the unpaid amount here is now 2018's unpaid amount. Alright, and the effective interest rate has changed to 4%. So, with the unpaid amount 315,000 and a discounting factor of 0.9615, our present value is going to be 302,873. So, since the effective interest rate changed at the end of 2017, we need to remeasure the closing balance of 2017 using the change effective interest rate, and that is equal to the present value of the unpaid coupon. So we are going to have this figure here. So we are going to have 302,873. So we've remeasured it. So our closing balance for 2017 is now 302,873 because the effective interest rate changed. So since it is more than, the remeasured is more than the closing balance, it is a loss. But an increase in liability is a loss. So now our closing balance will now become our remeasured balance will now become our opening balance. So that's 302,873. Then we charge effective interest rates using the 4%. But since the entity is redeeming itself, we have to do what we normally do. If you haven't watched my previous videos, kindly do so to understand that, because with this, it has already been given to us already. So we found the total payment. We found this. The difference between this and this is the 12,127. So it's advisable to bring it here so that we will have no closing balance, because the entity has redeemed the liability. So there shouldn't be any closing balance to be reported in the next year. So you can also try it. Calculate find 4% of this. It will be approximately this value. So it is always advisable to do it so. So we could see that this is quite different from the remaining, the previous ones we've done. So in this, we established that the closing balance of the ensuing year should be equal to the present value of the future unpaid amount. So since the future unpaid amount would have a new effective rate, the present value should be calculated using the new effective interest rate. So then we check whether there are increase or decrease in the closing balance, and that will be a gain or loss. Right. So let's see how this will be shown in the statement of profit or loss. So in the statement of profit or loss, we are going to show the effective interest rate is going to be our finance cost, and our fair value gain or loss will also be our income or loss. So whichever way it will be, it may be in bracket or it may be naked. Our finance cost, effective interest rate, we are going to report all this here, all this here. So 2016 it was 15,000. The losses, so they must be in bracket. Then the last one, that is 12,127. Now fair value gain. So that's for the first 2016, we made a gain as 5499, and in the second year 2017 we made a loss 5702, and 2018 it was redeemed, so there is no need to check. And since Excel has already been made, I made a formula and we have our closing balance. So we realize that our closing balance that will be reported in the statement of financial position will be the remeasured closing balance and not the actual closing balance. So the remeasured one. So 294 the first year, 29450 for 2016, and 302873 for 2017. 2018 the item has been redeemed. Thank you.